Hi everyone, this video is going to be the first in our series of videos for the Chapter 2 Excel homework. And so let's dive in here with the first homework problem. And as with all the different Excel homeworks, the first problem is just a bunch of kind of narrative type of questions. And yeah, let's take a look. So number one asks us, what journal entry is recorded when a materials manager receives a materials requisition and then issues those material for use in the factory, right? So as I mentioned in the video lecture for this chapter, these material requisition forms are the form that one employee would use to request materials for the project that they're working on, essentially. And so, not that they use these in every single business or anything like that. You know, you have to be a pretty big business to have your own materials manager, for example. But any larger business probably does have something like this, where the whole raw materials area of that business is kind of closed off. You know, that's not a bad idea, just to prevent for like security purposes and organization purposes, etc. And so if you really want to be well dialed in and have a good organized process, the individual who is working on the project directly would fill out that materials requisition form, give it to, for example, the materials manager in this question, and then that materials manager is going to look at the request, approve it, and that will all help with the record keeping and stuff. So anyway, so what is the journal entries that we're going to record? Well, when we get materials out of raw materials to go into a project, right, we're going to be moving that those raw materials from the raw materials inventory account to work in process, right? So we are going to debit work in process. And then if you remember from the last series of videos, if we want to move down a line when we are typing inside of a cell, you have to hold Alt and then Enter, and that moves it down. So just FYI. And then we are going to credit raw materials. And then let's do Alt Enter, because there's two parts to this as well. So the first entry we just recorded up here was for the direct materials that are going to be used in, let's say it's bread, just for instance, right? Pretty easy to talk about that. So the work in process, we're crediting the raw materials where our flour and sugar and salt and all the other raw materials are decreasing. That inventory of raw materials is going down, that asset going down. And then the work in process asset, inventory asset, is going up because we've moved those raw materials into work in process. And then additionally, for the indirect component, this piece is going to debit into manufacturing overhead, or you might see it as MO sometimes in the work problems, exercises, and things. And then Alt Enter to move down and type it in here. And then we're going to credit raw materials. And we could say raw materials inventory if we want to as well, just to highlight the fact that it is inventory. And we could also kind of combine these entries if we wanted. We could have debit work in process, debit manufacturing overhead. And so, since we are crediting the same account, you could just have this all as one entry, but I just kind of separate it out there. Doesn't really matter one way or the other. Okay, number two, why must a company estimate the amount of manufacturing overhead assigned to individual jobs versus assigning actual overhead? So there's a few different reasons for this, and we talked about it in the lecture video again. We use this predetermined overhead rate that we basically estimate the amount of overhead and then assign that to jobs. And we do that because of a few different issues. There's timing issues, there's cost tracking issues, financial reporting issues, etc. And I think the biggest thing to keep in mind is that the actual amount of overhead that the company will incur in a given accounting period isn't known until the end of that period, right? Because we have to account for all the the overhead every month, if we're talking about a whole year, for example, the total overhead that we incur for that entire year is so it would probably include utilities for that whole year again. And so we don't know what that actual number is until the whole year has gone by. But we need to start allocating costs to a job maybe on day one, basically, right? So we don't know the actual amount of overhead that the company will incur. We can also say overhead needs to be allocated to individual jobs on an ongoing basis. So like I said, that could be at the very beginning of the year on day one, and we don't know the full amount. So that's why we estimate it essentially. And we have a need for timely pricing decisions and cost tracking considerations. So I think that kind of handles it. The idea there is just that we don't, overhead is such a broad amount of different things, as far as utilities, property taxes, indirect labor, indirect materials, just so many different things. And some of those, like for any given year or quarter or whatever, we don't know what those are until the end of that time. And so the only real way that we can start applying some amount of that overhead to individual jobs is basically just to estimate it. And estimating it is what we're doing when we are using that predetermined overhead rate, essentially. Okay, number 3 says the textbook uses a percentage of labor costs to assign manufacturing overhead to jobs. Identify another factor or base a company might reasonably use to assign overhead costs. So the reason that we use direct labor cost a lot of times, especially in our homework problems and in-class problems, is really just because it's a very easy number to identify. In the real world, it's easy to identify. It's probably pretty simple to see on any given job how much labor costs are assigned to that. All you need to know is how many hours went into that job and which employees were those, and then you just need to know what that employee's salary or wages are, and then you could just multiply that by your estimated predetermined overhead rate, essentially, right? So it's kind of a simplicity thing. But some other factors, so let's see, other factors or bases might reasonably include, there was one, I think, in there, in our lecture video where they use direct labor hours instead of the actual direct labor dollars. That's a way to do it. Machine hours. So on machines, if you're in a factory, sometimes they can track how many hours were used on a given job, for that, with that machine. And if we say, oh, okay, we're producing some sort of product and we used 10 machine hours of that on that job, then we could just say for every machine hour, then we're going to allocate, whatever amount of overhead times that rate that we came up with based on machine hours. We could use units produced, direct materials cost. I'll just leave it at that there. So a whole bunch of, anything you could really identify. Again, this is where it's more of an art than a science. We need, as the company managers and cost accountants, we'd have to kind of look at our processes and try to see which of these factors or bases is the best link to total overhead costs that we can find. So you might look back and do some historical research to try and determine if we had used direct labor dollars, how close would we have been to actual overhead costs, at the end of the year? Or if we had used direct labor hours, how close? So you can kind of do some research to see which one of those factors seems like it's the most directly linked to actual overhead costs, and then maybe use that one. So just some other ones. But again, always when you're working on these problems with job order costing, be sure that you look and see what is the base that we're using when you're calculating that predetermined overhead rate, so that we always tell you generally. I don't think there's very many problems that you'll see where we're going to ask you to say, hey, pick your own base. Usually it says that we're calculating overhead as a percentage of, like I said, direct labor costs, direct labor hours, machine hours. We will tell you that information. But as I said, more of an art than a science. This is what we do as managerial accountants, is research stuff from a company perspective and find out what would be the best base. And then we might want to find out, well, why is, machine hours so closely related to total overhead costs and things like that. Okay, let's move on to number 4. How do you think a hospital might apply job order costing? We talked about this on the lecture video a bit, because when we said service businesses can still basically apply this methodology, it doesn't have to be a manufacturer. And when we consider hospitals providing services to a patient, all applicable materials and labor that has gone into treating that patient is recorded and used to produce a cost related to that patient's visit. And so, we're including, all that, materials, and we're not producing something again, but it could be, some patient, had certain medications, or maybe, certain things that they left the hospital with, a brace maybe, or like an ankle brace, or whatever it might be, bandages, anything like that. And then there's also obviously time of the doctors and nurses and all the employees who work at the hospital treating that patient. So we would track that as direct labor. But then there's also all kinds of overhead as well. Maybe I should mention that. We could also say there is overhead that also needs to be factored in, such as hospital utility costs. There's overhead that also needs to be factored in, such as hospital utility costs, so that the price of services is sufficient, or the price of services that the patient or the patient's health insurance provider, really, that's typically how it does it. So the price of services the patient or the patient's health insurance service provider pays adequately covers the hospital's total unique costs of care for the specific patient. Right, so hopefully that makes sense. Every patient could kind of be thought of as a job. When you go into the hospital, they have some, and they do have maybe not a job order sheet like we looked at in the lecture note or video or anything, but there is an electronic health record system that is in place. So when you check in, they're going to take information from you. They're going to take health insurance information from you, so they could bill your health insurance provider primarily. But they're going to aggregate all of the costs associated with treating you. Just like we aggregate, all those costs of direct materials, direct labor, overhead. They're going to kind of do the same thing, so that when you leave the hospital, they're going to say, okay, this patient was, they got treated for this thing, they used these supplies, and then we have to add in a different, amount of cost for our overhead. That's all kind of built into it, so that when the health insurance provider primarily, or the patient, if they're just paying out of pocket, when they pay the hospital those fees for the medical services they received, that service, the payment that they're making, there's accountants at the hospital who determine these things, and then tell the health insurance provider companies to say, hey, we need to be paid this amount of money, and that amount of money is there. It needs to be high enough to cover all of those costs, because if the hospital is paying all of its staff, and it's paying utility bills, and it's paying for supplies and all this kind of stuff, if it's not collecting enough money back from patients or health insurance providers for those patients, then the hospital is going to be in financial trouble, essentially. So kind of an interesting way to think about it. These concepts of adequately pricing things is not only applicable to products being manufactured, but obviously also to services as well. So you don't want to underprice things and have a situation where you're running into not having enough resources, enough money to basically keep, for example, a hospital running. So kind of similar to what we're looking at. Primarily we're going to talk about this from a manufacturing perspective, but hopefully that gives you a little context into how this kind of thinking and methodology can apply in a lot of different accounting related scenarios, regardless of the type of business or organization. All right, well, that brings us to the end of question number 1, and I will see you in the next video in our series for question number 2. Thanks.